Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned in to Next Level Charting. Thank you very much for joining us. It is Thursday, August 27th, and today we're going to test some moving averages for the S&P 500. We're going to test daily, weekly, and monthly moving averages and find the best. So we're just going to look at the S&P 500, and I want to find a good moving average combo to define the bigger trend for the S&P 500, and I'm going to use SPY to do that. And even if you're not trading SPY or the S&P 500, I think this is very important to know because the S&P 500 is the single most important barometer out there when it comes to the stock market. It is a benchmark used by many portfolio managers to benchmark their returns to be compared against. It accounts for some 80% of the total U.S. stock market, and it is the most widely followed index in the world. And so we need to know the direction of the S&P 500 to get an idea of the overall situation in the broader stock market. If the trend is up, things are doing good and we want to be long. But if the trend is down, things are not doing good, and we want to be out or maybe looking for shorts if you're aggressive. So we're going to look at 3 different time frames, daily, weekly, and monthly. And I did this exercise to decide which time frame I wanted to use and also the settings I wanted to use to time the broader market because I think there's been a shift in the last 5 years. I think the trends have become shorter and faster, and I'll lay that out on the charts. So as far as the moving averages are concerned, the longer moving average is fixed. So this is a daily chart, and our longer moving average is going to be fixed at the 200-day moving average. That is the most popular moving average out there, and you take it with the most widely followed index, the S&P 500, it kind of becomes a self-fulfilling prophecy when so many people are watching one index and one particular moving average. We're going to test the 200-day, and we're going to test crossovers. All right, we're going to test a 5-day crossover, which is the green line there, and we're going to test a 20-day crossover. You don't see the 20-day here. And the 50-day, the golden cross there, which is the red line. And I'm going to show these backtest results in a nice table so you can compare them. And then we're going to look at weekly moving averages. All right, we know that you get fewer signals with weekly moving averages. And so if you're getting fewer whipsaws, what does it do to the performance metrics? And I'm going to test those. So we're going to look at the 40-week moving average as our base moving average. And then I'm going to look at signals using the 2-week moving average, the 5-week, which is green there, and the 10-week, which is red. And we're going to test those because you can see that it looks really good when you see these signals here on this chart, but you never know until you actually test those signals and quantify them. And then I'm going to look at monthly moving averages. And we're just going to use the closing price, and I'm going to look at the 9-month, 10-month, 11-month, and 12-month moving averages. A close above and below those moving averages as the signals. And then I'm going to see how they performed over a 20-year period. And then I'm going to isolate a 5-year period to see if that performance improved, deteriorated, or what, depending on the moving average and the parameters. So, of course, the very first thing we need to do is set that benchmark, okay? So we're going to look at a 20-year period from January 2000 until August 2020. That's actually 20 years and 7 months. And so we can see the S&P 500, SPDR, SPY is up 124% during that time period. And that comes out to a 3.92% compound annual return. And that's not very good, is it? And it gets up to 5.89% when you add in the dividends. But we're going to back test without dividends because dividends the adjustments happen after the fact. And it tends to give an upward skew to prices. And I want to see the returns without dividends because I think dividends are basically like icing on the cake. We want to be the cake and look at the returns based on the price action And if we get a little extra from dividends, great. But we want to judge the system based on the price action without the dividends. Now, if you look at this return, 3.92%, it's because you had 10 years basically of going nowhere. You had the bear market and then the rebound, another bear market and a rebound. And then you got to new highs in 2013. And then we moved higher. So most of the return is from, this big run from 2009 to 2020. But again, the benchmark we're comparing, we want to beat 3.92% compound annual return. And we want to get lower drawdowns because you can see if you did buy and hold, you've got two 50% drawdowns and a 33% drawdown during the crash of March 2020. So the first thing we're going to do is test the monthly cross of the 9, 10, 11, and 12-month moving averages. Now, don't glaze over on this table because this is the only line we really need to focus on. It's the best performing monthly moving average, a cross above and below the 10-month moving average. And you can see compound annual return are very respectable, 5.42%. So if you start with 100,000 at the end of 20 years, you'd have 295,000. You would have been in the market 71% of the time, out 29% of the time. Your maximum drawdown was 20%. Now, relative to the return, that's big. That drawdown did occur with the March crash in March 2020. Win percent was 57%, and the gain-loss ratio was 3.91. So on the face of it, this one looks pretty good. When you close above and below the 10-month moving average, buy on a close above, sell on a close below. So here are all the signals over the last 20 years and 7 months. We've had 27 signals. Now, we started on a buy signal because the close is already above the 10-month moving average. And then we closed below, so we got a sell signal, and then some whipsaws. But you can see it caught some good trends, had some whipsaws in 2010 and 2015-16. And then the oscillator here shows when the close is above the 10-day, 10-month moving average, and when the close is below the 10-month moving average. But what I want to point out here is we have 27 signals in total here over a 20-year, 7-month period. So that's 247 months, and that amounts to one signal every 9 months. Now, for a longer-term trend following strategy, one signal every 9 months seems pretty good. All right, that's about what I'm after for a longer-term trend. But if we look at the last 20 months, since the latter part of 2018, we have had 8 signals, 8 crosses of that 10-month moving average in the last 20 months. And so that's one signal every 2.5 months. So this is a sign that the trends are getting shorter and faster. Volatility is picking up. And so that's why we have to be a bit careful when we're choosing our moving averages. And that's how I'll show how performance has changed over the last 5+ years. So here are the moving average signals. And again, you don't have to look at all of them. I'm just going to highlight the best one, and that is the 5-week crossing above and below the 40-week moving average for signals. You got 4.5% per year, so you beat buy and hold 3.92%. And you can see your drawdown was about half of buy and hold, but it was still higher than the monthly signal that I showed you before. It was at 28.5%. So it's not quite as good as that monthly signal we were seeing. And none of these weekly signals are good. So we're going to move on to the dailies. So here are the daily signals, and I'm going to highlight the one I think is best, but it's not the one with the highest compound annual return. That's the 50-200-day cross, the golden cross, 4.84% per year. But you can see the drawdown was 34%, by far the highest drawdown. So I opted for the 5-200-day cross here, 4.4% compound annual return, just be buy and hold, 20% drawdown, so a lot better than buy and hold, and that 50-200-day. And I think this is the sign that the trends are speeding up and getting shorter and faster. A 50-day has a lot of lag, and that lag is what produced this big drawdown during the March crash. And you can see going back to the 200-day, it didn't have the big drawdown, and the gain-loss ratio was 4.17, which is very good. Now, I talked about the changing nature of the trends that we're seeing. And if you look back to 2015, you can see that we had a volatile period in 2015 with a big corrective period, very choppy. And then we had a nice extended run, but then we started getting volatility back in 2018. A sharp decline, a 52-week high, a big plunge and a 52-week low, a bigger advance and a 52-week high, the March 2020 crash and a 52-week low, and then this move up. And this chart goes to August 3rd because that's the testing period, but we've since moved to a new 52-week high. But volatility started increasing in 2015. It took a break there, but it's been really increasing since 2018, and that's had an effect on these moving averages. And so now let's look at performance since 2015. Now, before moving on to the next testing results, I just want to point out, look at the performance since January 2015, up 60%. SPY is, there's that 60% there. And that comes out to 8.5% per year without dividends. This was an extraordinary run. But how did the moving averages perform during this extraordinary run? So you don't have to look at all of these, but the first one here is, or the second one here is when you buy and sell on a cross above and below the 10-month moving average. That was the best performing monthly system and the best performing system of all of them. But you can see during the period from 2015 on, it returned just 2% per year versus 8.5% for buy and hold. And you had a 20% drawdown, which is okay, but the gain-loss ratio was not impressive. The weekly didn't perform good. The 50-200 cross didn't perform good, but the 5-200 cross performed in line with prior results, around 5% per year during this period. So it underperformed buy and hold, but it was the best performing of these moving average crossovers that I tested. And the drawdown was 19%, and the gain-loss ratio was 4.38. And so what that leads me to believe is that these monthly signals, weekly signals, and signals that use, say, a 50-day moving average, they have too much lag to catch these short and fast moves that we're seeing now. And I think we need a shorter moving average like a 5-day and a 200-day for our signals. So the video that you just saw is coming from an article that I put up on trendinvestorpro.com on Wednesday. And this article includes all the charts and all the tables and more, as well as detailed commentary on the method behind the madness for choosing the moving averages. So check out trendinvestorpro.com. Very reasonable subscription prices if you're interested. So that concludes this edition of Next Level Charting for Thursday, August 27th. Thank you very much for tuning in and have a great trading day.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.